Good morning, good afternoon, good evening, wherever you may be. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled U.S. Banking Regulation, What to Expect in 2022. My name is Matt Bisanz, and I'm a partner in Mayor Brown's Financial Services Regulatory and Enforcement practice here in Washington, D.C. I counsel a range of domestic and global financial services firms on regulatory and compliance matters, transactions, and sometimes even investigations. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email on your invitation email. Joining me today is Mayor Brown partner Jeff Taft. Jeff is a partner and practice leader in Mayor Brown's Financial Services Regulatory and Enforcement Group, and also he works in the cybersecurity and data privacy practice. He focuses his practice primarily on bank regulation, bank receivership and insolvency issues, payment systems, consumer financial services, and cybersecurity and privacy issues. And with that brief introduction, we'll now begin today's discussion. As many listeners will be familiar with, U.S. banks have been subject to regulatory capital rules since the early 1980s. And in 1988, the Basel Committee on Banking Supervision in Switzerland adopted its first standards for regulatory capital rules. These were known as Basel I. These standards were implemented into U.S. law in 1989 and served us well through much of the 90s. In 2004, Basel, BCBS, issued major revisions to the regulatory capital standards, and again, the U.S. partially adopted these revisions in 2007 for its largest banks. In 2011, Basel again revised the regulatory capital standards in what was known as the Basel III standards, and the U.S. adopted these revisions for all U.S. banks in 2013. Now, from the way I've been describing this is an important distinction of that Basel drafts standards. The Basel Committee drafts standards, but they don't make law. In the U.S., law is made through the notice and comment rulemaking process that puts things into the Code of Federal Regulations and otherwise establishes the legal authority for U.S. regulators to impose obligations on private organizations. So in 2017, when the Basel Committee significantly revised the Basel III standards, these revisions were not immediately applicable to U.S. banking organizations. And the 2017 revisions have a number of purposes. There was an intent to reduce the variability in how banks calculate risk-weighted assets. There was also a desire to increase the comparability of capital ratios across jurisdictions. There was a issue with constraining the use of internal models. And finally, there was a desire to implement a capital floor, again, across jurisdictions. When the Basel Committee adopted these revisions, it indicated that they were intended to be roughly capital neutral across the banking sector, and for that reason, they did not change any of the minimum required capital ratios. They adjusted the risk-weighted assets and some of the other model-based aspects of the capital rules, but they were intended to be roughly capital neutral. When the Basel Committee made the 2017 revisions, it established an expectation that the 27 member jurisdictions would implement the revisions initially by January 2022, but this deadline was pushed back because of the COVID-19 pandemic until January 2023. We are sitting here now in February 2022, and there has been no public action by the U.S. regulators on the 2017 revisions by the Basel Committee. The U.S. regulators have again, on numerous occasions, indicated that they intend to eventually adopt the Basel III revisions, the 2017 revisions, and that they are working towards the 2023 deadline. U.S. regulators have, in various public fora, stated that the revisions will address credit, market, and operational risks for capital purposes. They've indicated that the revisions will go through the notice and comment rulemaking process, And on a few occasions, they've said that the revisions will be massive, enormous, various adjectives used to describe a very lengthy set of revisions. Given that the 2013 U.S. revisions were over 1,000 pages, this to some means that the impending revisions will be, again, on the stage of hundreds to, if not more than 1,000 pages of text. So why, though, are we here in February and we don't have rules? Well, there are some structural issues that in the U.S. regulators are not allowed to use external ratings as part of U.S. regulation, and there are aspects that we'll discuss of the Basel standards that are heavily tied to external ratings. There's also how the treatment of reserves at central banks and government securities that are held by banking organizations that was not as significant an issue in 2013 in the last series of revisions, or even in 2017, but has become more prominent since then. Further, from a structural point of view and not just procedural, the U.S. regulators remain in flux with regard to their leadership. The composition of the Federal Reserve's Committee on Supervision is expected to change. There have been recent and ongoing changes in the leadership at the OCC and FDIC. There's questions around whether to integrate any climate-related financial risks into the capital revisions. This isn't part of the Basel standards, but it is something that has become increasingly prominent in the U.S. regulatory sector. And finally, there has been a difficulty in maintaining capital neutrality at a bank level with respect to the revisions. That while the revisions may be capital neutral from the perspective of the U.S. financial system, some have expressed concerns that the larger banks in the U.S. could experience increased capital requirements, while smaller banks might experience actually a decrease in the amount of capital they are effectively required to hold. To touch on two of these issues, the first I'll touch on is the ratings-based, and that's because under the Basel Committee standards, if a jurisdiction is allowed to consider external ratings in its capital regulations, that jurisdiction can actually set lower risk weights for different exposures than would otherwise be permitted. And so as an example for risk weights for corporate exposures, again, remembering lower here means that banks need to hold less capital, that a jurisdiction that considers external ratings can get down to a risk weight as low as 20 or 50% for AAA rated borrowers. In contrast, a jurisdiction like the U.S. that is prohibited from considering external ratings, the lowest risk weight that a regulator or a bank under that regulator can get down to for a corporate exposure is 65%. And so that if the U.S. implements Basel III as contemplated by the Basel regulators, that could place U.S. banking organizations at a disadvantage to foreign banks that are based in jurisdictions that are allowed to consider external ratings. Another issue that the U.S. regulators are working through in drafting the proposal is what to do with central bank reserves and government securities. That for purposes of the leverage ratio, it's not risk-weighted, and so it looks at a bank's entire balance sheet. And so therefore, bank reserves are considered an asset, as are government securities, and they're treated like any other asset, like a loan or other instruments a bank may hold. And this is a problem because over the last few years, there's been a dramatic increase in the amount of reserves and government securities held by banking organizations. And so this has, in many cases, made the leverage ratio a binding constraint, a capital constraint for banking organizations when it was not intended to be that way by either the U.S. regulators or the Basel Committee. This is further complicated by the fact that the Basel Committee does not contemplate deviations in this area by national regulators, that at best they allow temporary exclusions, some of which were done during COVID, but they do not allow a permanent exclusion of these types of reserves. And so these are this is another area where it's unknown how U.S. regulators will solve it to provide some type of relief or more fair treatment for U.S. banking organizations. A second topic that we expect to see addressed in 2022 that will be of interest is climate risk management. And many banking organizations already have climate initiatives underway. They're being driven by market pressures in various areas like sustainable lending, but regulators are also starting to move into this area. That in late 2020, the Federal Reserve announced it had joined the Network for Greening the Financial System, which is an intergovernmental organization that develops scenarios and other quantitative models for how climate-related financial risks will affect the financial system. The OCC joined the Network for Greening in 2021, and the FDIC, in fact, earlier this week, announced its intent to join the Network for Greening. Subsequent statements by the Federal Reserve indicate that it is likely to focus on some type of stress testing as a way to initially address climate-related financial risk. There appears to be some potential, at least divergence among Fed policymakers on what this means, that it may not mean capital stress testing like regimes. It may be some type of smaller S stress testing or scenario analysis. And again, the Fed has not issued anything formally on this, but we're expecting to see some formal guidance on it later this year. Additionally, the OCC has been quite active, not in stress testing, but in the risk management sector. In November of 2021, it released questions that it is looking for the boards of its larger OCC-regulated banks to address, things around how climate will affect third-party risk management, how it will affect business continuity. The OCC's effort also included a survey on climate risk management practices at the largest banks that the OCC plans to use to inform some of its further supervisory activities. In December, the OCC released a set of draft principles for how it expects banks to manage climate-related financial risk or exposures to climate-related financial risks. This is based largely on draft Basel Committee principles and the OCC's relatively long-standing heightened standards rule. While the OCC will accept comment on the draft principles through February 14th, there remains a question of whether some of them may be immediately effective or whether there is an expectation to comply with the draft standards until and if they are finalized. So over the next year, we expect to see the OCC to release further guidance on the climate-related financial risks, maybe finalizing the principles, maybe issuing related guidance. We're expecting to see OCC examiners begin to ask larger banks about what they're doing to manage climate-related financial risks. And we also are expecting to see the Federal Reserve and other regulators launch their own initiatives. Like I said, the OCC signaled earlier this week that it may act more quickly now that it has new leadership in place and that it is likely to seek public comment on its own risk management guidance akin to the OCC's principles. And state regulators like the New York Department of Financial Services Climate Risk Management or Climate Division are likely to issue their own risk management expectations. So this is another area where there are going to be many more parties coming to the table. A third topic that we're looking at for 2022 are digital asset activities. And without going over the long history of what's been done to date, the OCC has recognized that national banks can engage in certain digital asset-related activities. This was in the pre-Biden administration, and it really right up until Biden took office, the OCC was going at full speed on chartering national banks that might focus on digital asset activities. It was considering specialized charters that we'll talk more about in a minute. But following the change in administration, the federal banking regulators have really pulled back on the speed at which they are considering digital asset activities. The Fed governors have expressed conflicting views on the necessity and structure of a central bank digital currency. There was a recent report saying that the Fed would probably be deferring further action pending both additional analysis and White House or congressional approval. And in November 2021, U.S. regulators issued a report on stable coins, a variation of central bank digital currency or a superseding concept. that indicated they would be looking for, or they would like stablecoins to be issued by insured banks and wallet providers for that type of digital asset would need to be subject to more comprehensive federal regulation. When that report was issued in November, the OCC issued a letter that retrospectively interpreted its prior authorizations to impose additional notice and risk management requirements on banks. And so banks that may have thought that there was their ticket had already been punched to engage in digital asset activities now found themselves subject to additional requirements. What all this means is that over the next year, we expect the federal regulators to issue guidance that will address when and whether or how banks may engage in a range of digital asset activities, including some traditional safekeeping and custody services, but also touching on crypto collateralized loans, distribution of stable coins, and even if banks can hold crypto or digital assets on their balance sheet. The Biden administration also has indicated that it may be planning to issue an executive order on digital assets in the near future that will attempt to coordinate the digital asset activities of the banking regulators and other federal agencies such as the SEC and CFTC, which to date have been proceeding at their own pace on this. And so the executive order may in some ways give more structure to the regulation of digital asset activities. A related concept to digital asset activities is fintech bank charters. Some of these are related to it, and as Jeff will talk about, some are not. Some fintech banks may not be focusing on digital assets, but overall progress for fintech bank charters has slowed. Pre-Biden administration, again, the OCC had announced several chartering initiatives. It had talked about special purpose charters, payments charters. There was some thought of using national trust bank charters as a way to give fintechs access to the banking systems. There was even some question of whether the OCC could charter uninsured full-service national banks. States had been similarly active in that Wyoming had authorized uninsured deposit-taking banks. Now, during the Biden administration, there's been a review of those prior authorizations or prior initiatives, and the OCC is generally less likely to grant applications that involve novel or fintech charter arrangements. Some fintechs have been able to acquire full-service insured national bank charters that are subject to the full suite of prudential regulation. Other fintech applicants have had to convert their fintech or novel charter applications to a traditional charter application or just withdraw them entirely. And from a public view, it remains unclear what will happen to fintechs that have received approval from the OCC for a fintech charter, and maybe they've not opened their doors yet. They're still in the formation stage, or in limited cases, they may be in operation. So that is one area that we don't really know what is going to happen in. The Federal Reserve came to the table late last year by proposing standards to evaluate requests from fintechs for access to Federal Reserve services to master accounts at Federal Reserve banks. This would be a way for fintechs and fintech banks to gain access to the payment system or even potentially the discount window. So far, the Federal Reserve has not acted on applications by several state-chartered fintechs for access to payment systems. There's only one state-chartered and uninsured fintech that currently has access to Reserve Bank services, and there's no indication that the Federal Reserve will adopt the pre-Biden view that the OCC had of broad automatic access to Federal Reserve services, that in some ways was a novel approach to access to the payment system services. There's also, with respect to the Federal Reserve's access to payment services, the potential for different outcomes based on geography, with there being certain precedent in the 10th Circuit that may differ in some respects from the 2nd Circuit, and so that is something that fintechs are paying attention to at more of the state level, which I'll turn it over to Jeff to address.
Thanks, Matt. And just kind of picking up on the banking chartering, obviously fintechs charter banks for different reasons. as Matt discussed, some of them do it, to participate in some sort of crypto activities, but others are engaging in more traditional banking activities. So some of them are obviously getting bank charters to have their own kind of bank partner program and moving away from the traditional bank partner programs that we've seen out there with a number of fintechs. And that would be kind of the lending clubs and the SoFis who've gotten their bank charters to kind of offer their own loans through their own bank. Because we have a dual banking system in the United States, obviously states can charter banks as well, and I think there's some healthy competition, as Matt noted, perhaps for some of these new types of charters that are being offered. And with respect to industrial loan company charters, which I think a lot of the fintechs have interest in, there's certainly been some activity around that, although not as much as I think people expected. In 2020, when the FDIC approved ILC charters for Square and for Nelnet, I think a lot of people thought that this may kind of open the door and there'd be a lot of ILC charters and deposit insurance granted for those charters, but we really haven't seen much since those approvals, and even after the FDIC issued its guidance for ILC parents at the end of 2020. Right now, you have a couple of applications that are pending for Utah ILCs. GM has an application pending. Great America has an application pending, and I think Brex had just withdrawn their application. Obviously, the ILC charter has a lot of appeal because it's kind of the holy grail of banking charters in the sense that you can engage in all types of banking activities, including most types of deposit taking, without being subject to the Bank Holding Company Act and consolidated supervision, examination, and capital. So I think that's a charter that still has an allure to it. Other fintechs like Credit Ninja are looking at a Utah bank charter. They have an application pending, and we're seeing some more interest at the state level in some of those bank charters. Obviously, some states are coming up with their own special charters. Nebraska has a digital asset depository institution charter. Matt mentioned the Wyoming charter, and I think you'll see more of that kind of as the states compete for some of the fintech business and compete for some of that chartering opportunities. So I think that's going to kind of be something we'll see going forward in 2022 and beyond. Another area that's going to get a lot of, I think, coverage this coming year is probably third-party vendor risk management. In July of 2021, the banking regulators proposed guidance on third-party risk management practices, basically trying to standardize the procedures used by the banking regulators and the banks that are engaging in contracting with third parties for services. Obviously, the rise of cybersecurity concerns has made third-party vendor risk management a very important concept. The fact that some of these vendors may provide a particular weak spot from security standpoint for some of the banks is something that's obviously caught the eyes of the regulators, and I think it's something that's going to be clearly subject to additional scrutiny. And I think that banks are going to have their practices, whether it's their onboarding of vendors or their constant oversight of vendors. Those things are going to be highly scrutinized by the banking regulators kind of going forward. And I think the banking regulators are going to basically try to ensure that these third-party relationships, which are becoming more and more prevalent with cloud and all sorts of other things that are going on, don't undermine the safety and soundness or security of the banking system. I think a lot of these third-party vendors are fintechs. Fintechs are becoming significant service providers to banks, broker-dealers, and investment advisors. These relationships allow them oftentimes to handle customer information, and they oftentimes may have access to information systems of the financial institution. So you can see why the regulators would be concerned about that. If they're performing services like underwriting and screening potential customers on behalf of the bank, obviously the banking regulators are going to want to be certain that those fintechs are performing those services in a manner that's safe, sound, and secure. So I think that's obviously something to kind of keep an eye on. The FDIC has a little bit of a novel issue, I think, with respect to some of the fintechs, and they're reviewing how these banks and these bank partner programs advertise products, and in particular deposit accounts that are being offered through some of these fintechs. We've even seen some of the regulators, for example, California has taken an action against Chime for the use of the word bank and banking in some of its advertising. So I think that's something that the FDIC is focused on. It's not clear how they're going to go about addressing this, but they may put out some regulations that address kind of the use of deposit insurance and advertising of that in the future. So I think that's something to keep in mind. Another area that we're seeing a lot of focus on are investment fund relationships. And I think that breaks down into two different distinct aspects. One is banks' relationship between funds and banks being scrutinized. Regulators obviously appear to be concerned that some banks view, for example, the exclusion in the Volcker rule for venture capital funds, as independent authority to make investments or to acquire control of entities. Obviously, banks need independent authority outside of the Volcker rule to engage in any sort of fund activities. The OCC has clearly reminded national banks of that fact. Obviously, compliance with the Volcker rule is essential, but before you get to that point, you have to have some independent authority to engage in the activity to begin with. So I think even though the Volcker rule was loosened up a little bit in 2020, I still think there's a lot of concern, and that's something that potentially even could be revisited in the coming year. Second, with respect to fund relationships, I think there's a focus on banks who have counterparties that are funds. Some of this is driven by some of the spectacular blowups we've seen over the last year or so, whether it's Archegos or some of the other ones. If you look at the recent FSOC issuance, they talk about some of the concerns that are being presented to the market by funds. And I think the banking regulators obviously have concerns that the banks are either going to be implicated in some of those risks or going to be subject to some financial loss because of their dealings with some of the funds. Obviously, it's important that banks assess the appropriateness of their risk management practices for derivatives when dealing with funds. Providing business and oversight relevant tools throughout the relationship with the fund. These are just some of the things that we'd expect, setting and maintaining appropriate margin levels and things of that nature, obviously so that they don't get particularly burned if there's a meltdown at the fund. That's something obviously the banking regulators are going to be carefully looking at. The final topic I want to cover off on, and I think this is an important one because just this week, Marty Grunberg, who is the acting FDIC chairman now, identified CRA, the Community Reinvestment Act, as the FDIC's #1 priority. The Community Reinvestment Act has kind of been kicked around the last couple of years in revisions to the regulations implementing it, obviously. Just for those of you who aren't familiar with it, obviously the Community Reinvestment Act requires the regulators to address rules and adopt rules that each bank must follow in fulfilling their obligations to the community, particularly low to moderate income borrowers and communities. Under the Community Reinvestment Act, there's not an annual, but a 3-year assessment effectively for most institutions on how they're dealing with the community. Regulators assign ratings to each bank, and these are publicly released. If a bank has a less than satisfactory rating, obviously that can have implications for the bank. If you're a financial holding company and you have a less than satisfactory CRA rating, that may limit your ability to undertake certain actions and could cause you to be subject to a 4M agreement. Obviously, there's public disclosure of CRA ratings, so everybody knows what your rating is. And those performance ratings may present reputational risks to institutions. They may preclude you from engaging in certain state or local government activities, including banking or underwriting municipal debts and obligations. So that's something that's important. With respect to the rules themselves, I think the good news is that I think everybody, the banks, the regulators, and the stakeholders all agree that it's time for the regulations to be updated. They were last updated in 1995 through an interagency effort. Obviously, banking has changed dramatically since 1995. And a lot of things that are in the CRA regulations really don't reflect how banking is done these days. So that's the good news. I think the bad news is there seems to be a lack of consensus as to how to go about changing some of these rules and the regulations with respect to CRA. Kudos to the OCC who took a stab at it in 2018 where they issued an ANPR and then followed through with detailed final regulations that were revising the CRA regulations applicable to national banks and federal savings associations. Unfortunately, the OCC could not get the FRB and the FDIC to join into that rulemaking, so it effectively left the OCC and their banks as having separate rules. I don't think that was the ideal way to approach CRA reform, but ultimately that was the way the OCC went. In the subsequent year since the rule was finalized, the OCC has basically backtracked and effectively rolled back that final rule that it issued in 2020 and basically reverted back to the 1995 revisions that they entered into with the FDIC and the FRB. Obviously, the three agencies now are getting together to propose and issue a proposed rule according to the FDIC in the very near future. This is obviously important because it will kind of at least maintain a level playing field amongst the depository institutions as to what their CRA obligations will be. What the crux of this proposed regulation will be is somewhat unclear, obviously, at this point, and I think we're all waiting to see what the regulators put out. I think the OCC rule obviously had a number of important changes, some of which I think everybody agreed upon. Perhaps changing the assessment area, kind of moving away from the branch focus CRA, as so little of banking these days tends to be done at branches. There's probably a better way of measuring assessment areas or identifying what assessment areas may be. Hopefully that's something that will be picked up by the modernization by the three agencies going forward. I think some of the other things that the OCC did with their rule was to give additional clarity to banks so that they would understand what kind of credit they would be getting when they engage in certain types of activities. I think that certainty was something obviously that appealed to the banks. Obviously, I'm not sure the regulators will come and revisit that point again, or that they'll follow the OCC's model, but obviously that's something from the banking standpoint I think that the banks would like to see in any revised CRA rule, such that they'll have a better understanding when they enter into transactions as to what the CRA, credit for that transaction would be. So we've covered a lot today, kind of gone through a windfall of a whole host of things that will be covered, we think, in 2022. Obviously, there'll be other things that will come up from time to time. But we appreciate your time today for tuning in. I do want to give a few brief reminders before we disconnect. One, you'll receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Second, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may now all disconnect.